Good afternoon on this wonderful, bright Wednesday. Um, this is our second session on mastering your finances. And those that have joined us online, thank you very much for joining us today. And those that will be going through our presentation on YouTube, you are most welcome. Just as a reminder, again, if you have missed the session or you want to go through the session again, go to our YouTube page, MMCP Advisors. That's where you will find all the previous slides and presentations on building your wealth, or the MMCP Wealth Builder series. So today we are dealing with part 2 of mastering your finances. Those that were in our session in the previous month will recall that we were dealing with businesses. The session today is for individuals, and we are going to tackle some of the light issues in terms of mastering your finances. Um, the most important thing that we will be looking at is understanding that your relationship with money is the first step in you mastering your finances. Most of the time, we are being told that you need to take care of your money, you need to do this and this. However, there are embedded um, aspects or issues that affects how people deal with money. So understanding how your relationship with money is the first step of actually mastering your finances. My name is Ntabiseng Maidi. I'm a chartered accountant by profession and I hold an LLB, and I'm also a financial advisor at MMCP Advisors. So let's look at what we are going to try to achieve today. We're going to try and see to see how do we look at money differently, and what are some of the basics in financial planning? How do we budget effectively? How do we manage expenses without feeling as though we are chasing our tail? And consistency and the financial habits that are there for you to implement or to take on, the toolkit by a specific role as a person, and any resources that we might be in a position to provide you with to make sure that you start adopting money management skills. So I'm one person who goes through a few reading material from time to time, and some of the books that I have read that are out there indicates that in the psychology of money, Morgan Housel says that your childhood experiences usually determines how you handle your money. If you grow up with a scarcity mindset, most of the people find it very difficult to actually adapt because they've got this thing that it's difficult for me to get money. Money goes only to the rich. Even if I try to do this and this, I will not be able to do it because in my family, there's no one who has actually broken that scarcity curse, if I can call it that. So your childhood experiences um, uh, affect how you actually see money. So if you want to learn more about this, just go and read on the psychology of money. And the next book that I've also looked at is Your Core Values as a Person Determines How You See Money. If you're a person that likes reading, that likes travel, that likes sporting activities, um, and who is more church orientated. When we look at your income statement, sorry, when you look at your bank statement, we can, by that we can determine what kind of of a person you are. That book that says Your Money or Your Life actually indicates that your core values as an individual will determine how you see money. If you are a person who likes entertainment, obviously your bank statement, most of your money will go to what you value most. As I said, if you value reading, you will spend most of your money on reading. If you like traveling, it will go to traveling, just like that. The other book that I've gone through is Habits and Systems, and that are found in Atomic Habits. And James Clear in that book indicates that if you start creating a smaller habit by a certain number of days, some say it's 21 days, some it's 90 days, you already create a habit on actually how to do certain things. So that book as well proves to us that once you create a habit of saving, it becomes embedded in your life. That's what you do, and you start being consistent. Some of the other things is your emotional triggers and beliefs. I've spoken about those who believe that in their family there's no millionaire, so there's no way that I'll be in a position to do that. Some is emotional triggers on money. Say you grew up very poor, and once you see a person who's very poor, or you see other people who are poor, you tend not to want to spend because it raises some, you become nostalgic on some of the things that you have gone through emotionally from your previous experiences. Next is your cultural and social norms. I've spoken about your social life. If you are more into a social life, that is going to affect money. And lastly, your personality and risk tolerance. With regards to risk tolerance, as financial planners, when a person comes through to for financial planning session, we look at your risk tolerance. That you can have a risk tolerance of a certain level. However, what we do is we compare that with your risk capacity, and we compare that with your risk profile. And that's what we can also determine that what kind of a person are you when you actually spend your money. So those are some of the key influences on what makes us see money differently. So let me start off with financial planning. I know that there is a myth out there that financial planning is for rich people. Financial planning is for certain types of planning, um, and that is incorrect. Financial planning is for everyone. It doesn't matter whether you have got little more or you don't have, because we all need to understand what goes into financial planning. Some of the things that we look at is we look at what can be your short-term goals, your medium-term goals, and your long-term financial goals. And how do you make sure that you achieve your goals? How do you make sure that you are properly covered for risk management? Risk management meaning you have got proper cover, whether it's for a vehicle, for funeral, for your children's education. So we look at that. Lastly, we look at long-term retirement planning or investment or saving if you want to achieve certain goal. And there is a process that we follow in terms of what do we do when we look at financial planning, because this is a very organized environment. We look at, as I said, what are your goals? what information is out there, or what information do you have that can assist us to determine how we can achieve your goals? And we then go and analyze the information. Earlier on, I've spoken about risk tolerance, your risk profile, and your risk capacity. We look at that as well. We look at what kind of products do you currently have out there, and also and check whether you are not over capitalized or over insured in one environment, and the other one you are not actually covered. As a financial advisor, we will go and recommend certain changes to your portfolio, especially where we find that we have got a similar cover from two different service providers, and that cover doesn't actually benefit you. And on an annual basis or on a regular basis, we look at the progress. So we review the progress on how we do that. And this has got its own benefits, whereby you have got peace of mind should anything happen to you. If you have got children, you have got peace of mind for your children to go to university, and you are in a position to figure out what are your priorities. Some of the things that I don't have here is a financial planner assists you in terms of having an accountability partner in assisting you to reach your goals. And some financial planners will charge you a fee for doing advice. Some will say, no, I'm going to take a fee from the investments that you have done. So financial planning is quite critical in actually you starting to master your finances. The other benefit that you find from financial planning is a learning process. The more you engage with your financial planner, the more you actually get information or you learn about your personal finances. So some of the things that a financial planner or any financial planning activity should have is the base will be on looking at your cash flow management. And cash flow management means, do you have sufficient cash to be able to do certain things? Do you have cash flow to do investments, to pay for your insurance policies, to buy a car, to buy a house? And this involves budgeting as well. The next one is we look at risk management. Risk management is, do you have a life cover whereby you are matching your liabilities with your assets? And those that have attended my sessions on financial planning will understand, will also know that in that area, I talk about asset and liability matching. One example is if you have got a mortgage loan of about 4 million and your property is about, say, 3.5, the value of your property. It means if you were to sell that house, or when you die, we use that a lot when you die for a life cover. The difference between 4 million and 3.5 is 500. So your insurance policy is going to cover for that shortfall in that. So basically, what we look at in risk management, we look at such things um, on risk management. We look at your liabilities. How will you settle, or how will your loved ones settle the liabilities in case you pass on? The other one is income protection. You lose your job or you are ill, you are not in a position to work. How do you actually get money on a monthly basis? The next one is on investment planning. Oh, before I go to investment planning, under risk management, we also have medical aid, that you need to have medical aid to be able to pay for your medical expenses should you need them. We go to investment management, where we say, let's look at where can you invest, or what can you do to reach your savings goal. Next is tax planning. It doesn't make sense for you to have a financial planner, but you don't look at your tax minimizing strategies. And you must understand that I'm not saying tax evasion strategies. I'm saying tax minimizing or tax avoidance strategies. There are different products that you can use, and your financial advisor can talk to you about that, where you can use those products to be able to reduce your taxes. Next is retirement planning. Do you have sufficient income to maintain yourself when you retire? And lastly is estate planning. Should anything happen to you, do you have a will for the massing of your assets? Do you have money for your children if they are still young, for them to be able to go to school and that? So those are the stuff, the things that we look at in a financial planning environment. And any financial plan at the end should be in a position to allow you to cover all those 6 areas. Um, going next to why is it critical? In our session from last month, we were focusing more on businesses. Today, I just want to focus on professionals and those that are self-employed and business owners. With professionals or any person where you have got a stable income, some financial planning is going to assist you with retirement savings as a base, insurance, estate planning, and that. Then even tax planning. When you are a self-employed person, because you don't get regular income, tax planning becomes very important, and separating your personal versus your business expenses becomes very important as well. And this is a pain point for those that are self-employed, because sometimes you end up not knowing as to how to actually plan for retirement as a self-employed person, and how to actually have insurance as a self-employed person. Because for a professional or someone who's earning a stable income, those are very easy, because sometimes your employer would have actually done that on your behalf. So it means when you are in these 2 categories, the bottom ones, you have to make sure that you actually do that yourself. And then lastly, for business owners, they spend most of their money and time in their businesses, and most of the time they forget that they have to live outside of a business. We have seen that with COVID, where a lot of businesses were actually affected, and some of the business owners had to actually leave that lovely idea that they had to go and seek employment. And here we say, let's look at your cash flow management as your business owner. In one of the sessions that I've run for business owners, I've spoken about paying yourself first as a business owner. So how do you make sure that you manage your cash flow by earning a salary from your business? How do you also make sure that there's business sustainability and continuity? We do have financial products that can assist you in having sustainability and succession in your business. And lastly is wealth extraction strategy. At what point do you actually realize some money out of your business as a business owner? So, and all of this, you can have a good discussion with your financial planner. And this is this list is not exhausted. There's quite a lot that we can actually cover for each and every one of those areas. So let's go to what we are here for today. How do we start talking about a budget? We all know that a budget is a plan on how to actually spend for your the income that you receive by distributing that income amongst your expenses. And it also helps you to control your spending so that you can reach your goal of um, saving. So we use the 50-30-20 rule. And there's different kind of rules from different motivational speakers. Some will say 50-25-25. Some will say 60-20-10. So they are different. The one that I would like us to talk about, which I feel is a bit reasonable, is the 50-30-20. And let me also put a disclaimer on here that I'm assuming that the person who is doing this doesn't is just a normal person who's got a certain limit of income. So first, your 50% must go to your what we call necessities, and this is your housing, your rent, food, transportation, bills, and utilities. And then the next 20%, and this can either be 20% or it can be 30%, where we look at emergency funds, debt pay, repayment, retirement funding, as well as if you are tithing, you can include your tithing in there. Then the last one is what I call discretionary spending, which is more your wants, and your dining, shopping, subscriptions, travel, and that. So this is the 50-30-20 rule that you can utilize. I do have a workbook that I can share with whoever that is interested in the workbook to who can to assist you in the budget process that I'm talking about here. So probably let me see if I can go to that spreadsheet whilst we are there. So how it looks is that in your budget, let's start off with a monthly one. So this is your monthly budget where you indicate that this is my income after tax, and assuming that assuming that you don't only earn an income, there are some that are earning rental income, some have got other income that they get. Include that in your budget so that you can see where you actually spend your money. This is not only for salaried people. So you have to go and indicate what are your necessities. This is a bond, car, petrol, utilities. You list that and it will give you a total. And then you go and you look at your discretionary. Sorry, I'm going to change that. And so you can put what are your discretionary expenses. And here you have got subscription, DSTV subscription, restaurants, clubbing, and all of that. You put that there. And then the last one is on giving, saving, and investing. You put how much are you giving, how much are you spending on saving, and how much are you spending on investing. So you do that. So this spreadsheet is available, will be available for the attendees in order to track your monthly spend. If you have done that, you can actually, at the bottom, it will give you percentages of how much of your total income is going to your necessities, to your discretionary, as well as to your last part, your giving, saving, and investing. So this can help you to start the process of getting into the habit of doing a budget. If you are like me and you like to budget for a full year, so this is what I do on a regular basis. Mine, I do it on a 12 months rolling period, meaning that I look at my income for the next 12 months at any given time. I'm self-employed, meaning that I constantly have to look at when is my available cash going to run out. So I put on my salary and all the different incomes that I'm getting for the next 12 months. And then I also assess where I am currently, which is on giving long-term investments. And let me also indicate that this retirement that I'm talking about here is assuming that you have not maximized your retirement contribution with your employer. Their maximum retirement contribution for any taxpayer is 27.5%. And for most entities, they usually go to about 15%. Some go to 21%. So the difference between what you are getting from your employer and what you have, you can also put it here, and it allows you to reduce your tax. So this is the additional amount of retirement that you want to do. Then you have got your medium term savings, your short term savings, and this is mostly your emergency funds and a fund for buying a car, for getting married, for traveling, and that. And then you have got a percent, some of your necessities, your discretionary, as well as your debt. So this is what I assess as my current. Then I look at, based on the principles that I've spoken about in here. So on the 50, 30, 20, then I look at how do I actually start putting that. I've got 10% for giving, I've got 10% for retirement. I'm adding to what I already have. I've got medium term and short term. So if you add all those three, they give you 30%. And then I've got the necessities, which is 50, and I've got discretionary, which is 20. So let me talk a bit about these necessities. The necessities will usually be your home and your car, your insurance for your home, insurance for your car, and the utilities. So when you look at, when you do your budget, add together your house expenses together, especially those that are necessities. If it's a bond, it's your house bond, it's insurance for your house, they go together. If it's for your car, it's your car tracker, and so that you can see how much are you spending on your house, on your car, so that you can, if you want to make changes, that's when you will see if you are spending more or less. So, but the limit here is 50. So this template will be available in as part of the slides that you're going to get. So let's move then in terms of the steps, because most people are saying, hey, no, I can't do this. How do I do this process? This is a difficult process to do. Believe you me, creating a habit, you do it once, you will be in a position to do it as often as possible. The first step, which is the most important step, is you need to create time. You can't do this in passing. You can't do this 5 minutes. Probably if you have already done it before, you can do it in 5 minutes. But this is a if you are starting, take a Sunday afternoon, make it 2, 3 hours, 1, 2 hours, and sit and analyze all of your expenses. Because once you do that, it's going to be easy for you to update your budget going forward, because you understand your figures properly. So the first thing is creating time. Next is make sure that you track your income and expenses, or your income sources. If you are using one bank, I've seen a lot of banks have got what they call money coach. Some net bank, I think, has got expense tracker. So What I like with most banking apps is that they assist you in tracking your income and expenses if you are using one bank. Make use of those facilities. Some of them, they are actually free. Then you list your monthly expenses. You categorize your expenses into your fixed, your variables, your discretionary, as well as your necessary. I've indicated that your necessary is your rent, utilities, your groceries, insurance, loan repayment. But this loan repayment as well, you must be careful because they fall into discretionary as well. Loan repayments here, I'm referring to your house bond. If you are taking a loan to go on holiday, that is a discretionary loan because you can do without that holiday for a year. And then you must also have discretionary expenses, which is eating out, subscriptions, luxury items, holidays, and entertainment. Once you understand that these two differences, I'm telling you, you are going to get out of the debt rat. So we've got your steps there. You need to set your limits. I've given you the limits in the spreadsheet, and make sure that you review on a monthly basis to make sure that you are actually improving. Remember, I spoke about habits. So this is where you start establishing habits. Um, so how do we manage our expenses? Let me say that out of all the issues that I'm going to be talking about today, this is a new concept to a lot of people, and let's make sure that we understand it quite well, because this will impact your budget significantly. And I call it a pure method. This you find in most businesses are actually using this process where they do a pure analysis in managing their expenses. The first one is P stands for plus or add. So here you are looking at adding emergency fund contributions, retirement savings, your TFSAs, if you didn't have insurance, educational costs, if you were not studying, or if you are not buying books, or if you are not doing anything educational, debt repayment. This is the additional debt repayment above what you have been paying before. I'll talk later on. I'm going to talk about reducing your debt. And the other one is your investment. So this is what you add. Yeah. And then the next one is, what do you remove from your budget? Remember, you have listed all of your expenses, even the once-off ones. You must list them. What do you remove? You are removing your wasteful expenditure. There's a lot of us that have got unused subscriptions. Look at your bank statement. Those 10 rands, 15 rands, 150 rands, they add up. Remove unused subscriptions. Impulsive shopping. Plan your shopping as much as possible. Um, and looking at what you can also what you can change out of your impulsive shopping. Remove that, do that. Redundant insurance. The reason why I spoke about having a financial planner is for them to assist you in dealing with your redundant insurance. There are some people who took a life cover with some company 15 years ago, and this life cover just renews, and they pay and the amount increases on an annual basis, um, and it doesn't suit them. You find a person is paying 3,000 rands on a life cover, and when you look at the payout doesn't even match what that life cover, what they're paying on the life cover. So your financial advisor here will be in a position to tell you that, hey, this policy is just redundant. You'd rather stop it and get something cheaper or better. Next one is excessive takeaways. We've got a lot of culprits that are doing excessive takeaways, and with the ease of doing takeaways, it's very easy for one to spend close to 3,000 rands in a month. If you want to see whether you are doing excessive takeaways, use one. Probably if you are using Uber Eats, you can be in a position to draw a statement for you for a month, and you can see if you are spending more than 20% of your salary on Uber Eats, it means you are in trouble. So you can actually do that. Banking fees for dormant accounts as well as multiple bank accounts. I'm also a culprit here because I bank with all the banks, and each one of them, they might be charging me about 600 or 700 in banking fees or 500 in banking fees. When you add all of that, it's 2,000 rands. 2,000 rands can pay a tax-free savings installment. So that's what you need to look at. The next one is look at the R, stands for replacement. So by the way, sorry, the U is unnecessary. So let's go to R. R, we are saying, let me replace and find a better alternative. Changing brands, data plans, or mobile plans, um, retail therapy, car leases, using Uber instead of driving your car, or moving from a car to a motorbike. And the other one is consolidating high debt to get better rates of interest. There is also a myth out there that once you consolidate your debt, it has got a bad or an adverse credit um, um, uh, impact for you. There is some debt that is good. So if you are in a position to consolidate your debt and it allows you to be able to improve your credit profile, do that, but make sure that you pay it and you don't lag behind with your payments. And then lastly is, what do you leave unchanged? So this one is you keep, and these are essential, or you are going to optimize on this. This is your rent or your bond payments, medical aids, your school fees, transport, basic groceries, and utilities. So this changes your expense line drastically. I have done it several times, many years ago. One of the things that I don't do, I don't subscribe to one of the TV channels, because for me, I don't watch it, so there's no need for me to have it. And I found that I'm saving close to 500 on a monthly basis on that, and I can utilize that somewhere. So make use of this technique. Let's go to the next one, which is called paying yourself first. Normally what we do is you get your salary, you pay bills, then you start spending whatever that is left, is then when you say, I'm going to tithe, I'm going to save, or I'm going to invest. That becomes last in the chain process. But what you can do is that, and this is how you find yourself in a chasing your tail, because you can go to an extent of overspending here, because you are buying and buying and buying even the unnecessary things, and without realizing that you don't have that. So we're saying that is incorrect. And the best way of doing it is to say, when you get your salary, automate your savings and investment contributions first, and your tithe, obviously. Prioritize your emergency fund. It's then that you are going to pay your bills, and you can spend the balance on on spending. Let's go back to our spreadsheet. So the first 30% here, giving long term, medium term, short term, the first 30% must be a debit order. So what you work on for your monthly spending and all of that, you only work on 70%. Once you create that habit, it's going to be very difficult for you not to be able to save. Some people would say, but it's not possible. I'm saying it's possible because I've known of people who have done it, and I'm one of those. Let's look at consistency. Um, Consistency is quite important when I was just talking about investing. And this I also found in Atomic Habits, where he says, if you don't rise to the level of your goals, you fall to the level of your systems. If you don't have systems, it means you will not have anything. Let me just give you an example of investing or saving monthly. If you were to save on a an instrument that grows at a 10% per annum, within 7 years, you would have doubled you would have doubled what you have saved. One example is those that have got that have got a preservation fund. If you've got a preservation fund, you made one investment in 2013, and um, you don't touch it. You have invested in good assets. Your financial advisor has recommended good unit trusts for you. It is very easy for you to double that amount. And you can do that within 7.2 years. The lower the interest, obviously, the longer it will take you to double your money. So just also make sure that the money that you have invested is growing at the rate that is more than inflation. That is very important. And this you will see when you talk to your financial advisor. So, consistency. The more consistent you are with saving and investing and changing some of your habits, the more you're going to get better returns and much quicker. Let's talk about the snowball effect, which is the next thing. Snowball effect is when you pay the smallest debt. Let's say you have got debt and you don't know how to deal with it. You either do use two things. One is the avalanche, where you pay the most expensive first. You just put a huge chunk of money into it, or you do a snowball. And a snowball says you pay off the smallest debt first and roll into the next one. Um, you are also going to get a template that will assist you in assessing your debt so that you can be in a position to look at which one are you going to tackle first. So this is one of the spreadsheets where you really need to understand your capital amount, your interest rate that they're charging you on this debt, the installment per month. And if you look at the interest rate, it must actually tell you that you need to prioritize the one with the highest interest rate and get rid of it first. The first two usually are quite a bit difficult for some people, because you might need to change banks. But here you can also negotiate a good rate for your bond. And motor vehicles, you can actually do that unless if you are not lazy to be buying cars every 3 years and that and negotiating on your interest. So you need to understand the type of debt that you have. These five at the bottom are what I call discretionary loans. And these ones are the ones that you might want to focus on first because these are bad credit, these ones. So when you prioritize, I'm expecting that the 1, 2, 3, 4, 5 is going to start here before you go to the top ones. So that is your snowball effect. And let's also talk about snowball effect when you save. I think a lot of you have seen a snowball when it starts small and it goes big. The more it rolls down the hill, it becomes big. That's exactly that. As you start saving, start with 500. Next year, you have improved, you go to 1,000. The other year, you go to 2,000. That has got a much bigger impact on your finances. So you can start doing that. So here I've got a toolkit for some of the roles that I've spoken about before earlier on. Is some of the toolkit that you need as a person when you look at your finances. Um, as a professional, you must have your emergency fund. They say between 6 and 8 months of your salary. That's what you must have. And this could be in addition to your retirement plan or retirement annuity. Remember, a retirement annuity, you can only access the vested amount, and the non-vested amount, you'll have to wait until you go on retirement. So you need to build the emergency fund. Those that attended our Wealth Builder series, when we spoke about the two-pot, you can go back and look at that, and you'll get more ideas on actually how to improve your emergency fund. The next one is tax efficient investing. Lastly, estate planning, having a will and making sure that your loved ones will be able to deal with your assets when you're gone. I didn't and this list again is not exhaustive because you also need to do risk management as well. If you are self-employed, we're talking about tax planning, medical aid, income smoothing. Income smoothing here, we're saying you get a lump sum of money in January. How do you make sure that it lasts you until December if you get that money once a year? Income smoothing strategies, your financial advisor should be able to help you with that. Lastly, estate planning. And then for business owners, you need to know your cash flows, both from your business and yourself. You need to look at your life covers and risk management, medical aid, tax planning, as well as estate planning. So those are the different toolkits that you need to have if you fit any of those three. Let's look at a simple action plan. So from today, luckily next week it's Monday. Today, Kitty 25, for those that are getting paid next week, you will be in a position to sit and look at how we are going to do it. Track your expenses for 30 days. If you are used to paying things for cash, try to use your card this time so that you can be in a position to download your bank statement and track your expenses from your bank statement. Then work on creating your budget. This is very important that we fall into the trap of not knowing or of having too much debt or not being able to save because we don't give ourselves time to learn. There is financial management for non-financial managers. You don't need to know intricacies of finance, but just the basics of finance. Just give yourself time to do that. Have your goal, savings and debt reduction goals. Automate one habit. Don't do everything at the same time. That is why we end up not being able to achieve what we set to do because you want to do everything at the same time. If your goal for this year is to reduce debt, work on that goal alone until you are in a position to say, okay, I've mastered the process, or I've reduced my debt. Now I'm gonna go into the next thing. Just this is also quite critical. Hence, people, I said, are not in a position to manage their finances because you want to do two things at once. You cannot say, my goal is to reduce debt, but you go and you change your car and you go for a much bigger car or the most recent car. Obviously, your installment will be much higher. So, if you set a goal, work on it, achieve the goal, move to the next one, review your progress, and just have that attitude of doing it. Don't like, if you have to sit and do a budget, just have that attitude to say, on Sunday afternoon after church, it's not that busy, I'm going to sit and do my budget or review my spending. That's how easy it is. So I see our time is almost over. The next things the next thing that I want to say is just to say, start today. Those that got paid today, don't go and spend without taking a book and writing some of the things in your notebook or doing it on your computer. Start today. They usually say the best time to plant a tree is yesterday. So you can start today to look at some of the strategies we have suggested here. Just be consistent, and I am sure you are going to reap the rewards. So lastly, as I indicated, I've got a few templates that I'm going to offer. One is on your budget templates, your goals worksheet, your debt tracker, and I think here I already have 3 of them, and your expense log. So all of the best in changing your finances. And if you are interested in chatting to us as part of our wealth management process, you are most welcome to take a picture of this or to access this. There's quite some information that you can get from a financial planning point of view to advisory services. Um, and thank you again for joining us on this session. We're looking forward to seeing you in the next session. And the next session we will be focusing on retiring. There's a lot of people that are being retrenched. Some are retiring, some are leaving their jobs. So the next session, if you have got an uncle, aunt, mom, sister, brother that is going on retirement very soon, in the next 3 years, we don't wait to talk about retirement 2 months before you leave your job. You have to actually plan for it. So the next session that we will be doing will be on preparing for retirement. And preparing for retirement is not only for the elderly. There are people who will say, I want to retire at 40. And you are most welcome to join us for that session. Be on the lookout. And again, thank you very much for joining us. If you want to access this, go to our YouTube page, and do not forget to follow us on the social media platforms, Instagram as well, Facebook as well as Twitter. And have a good afternoon. Thank you.